Okay, welcome back to this session of strategic financial management. We were speaking about how, on the basis of the retention ratio and the cost of capital, we are dividing the companies into growth firm, constant firm, and declining firm. Now, for any growth firm, which is considered by seeing the R and KE, where return shall always be more than K of KE or cost of capital. The optimum dividend payout ratio for such companies shall be 0. That is to tell, dividend payable shall be 0 and retention shall be 100. For any constant company, the R shall remain always at the same as that of cost of capital, and because of this there shall be no any optimum ratio or optimum payout ratio. That is to tell, whatever the ratio of dividend payout ratio stands at, there shall be no any difference in the value of the company. And for a declining firm, the rate of return shall always be lesser than cost of capital. So the dividend payout ratio shall be 100%. That is to tell, the company, to maintain its position in the market and to become better in the eyes of shareholders, should give the entire amount for the shareholders in the form of dividend, and nothing shall be in the hands of the organization in the form of retention ratio. If at all the company wants any amount, then it will have to raise it once again in the market. Now these are some of the assumption of Gordon model. Now, speaking about all this, the one thing that we can notice in Gordon model is that when internal rate of return is greater than that of cost of capital. Now, what happens is that the price of the company shall increase, and because of this, the dividend payout ratio decreases, and the situation would be reverse. That is, if at all the internal rate of return is lesser than that of cost of capital, then the price per share shall decrease, and thereby dividend payout increases. Now that is nothing but the explanation of what has been given in the table. So, according to the formula, it is better for us to see one of the illustration so that it shall help us to understand more. The same question that was taken earlier has been taken once again, with the figures are collected from the annual report of XYZ Limited. Now, XYZ Limited has a net profit of 30 lakhs and the outstanding preference shares stands at 12%. The number of equity shares is rupees 3 lakhs and the return of reinvestment is 20%, and the company is having a cost of capital which is standing at 16%, and they are asking to calculate the price per share using the Gordon model. And not only that, they have also given information regarding the payout ratio, wherein under the first circumstances the payout ratio is 25%, under the second circumstance the payout ratio is 50%, and under the third circumstance the payout ratio is 100%. Now again here we'll have to calculate first the E, then the rest has been given in the formula. Now net profit is 30 lakhs. Out of the net profit, since we are having preferential shareholders, dividend shall to have to be paid for the preference shareholders, and out of 100 lakhs when we pay 12%, it shall be 12 lakhs. So the earnings for equity shareholders would be 18 lakhs. And the company is having 3 lakh equity shareholders. Therefore, each of the equity shares would be earning rupees 6 on its investment. When all these figures are applied to the formula, and taking into consideration the dividend payout ratios, now for the first one, E shall be 6, the payout ratio is 0.25. Here 1 minus B is nothing but payout ratio, which has been given deliberately in the problem, whereas B represents your retention ratio. 1 minus B will always tell it to be shows you the payout ratio. So 1 minus B is 0.25. KE they have given, which is standing at 16%. B is a retention ratio. When 25% is payout ratio, definitely the remaining 75% shall be retention ratio. That's how here 0.75 has been considered, or B is nothing but 1 minus payout ratio. And 0 point R they have given it to be 20%. So that is 0.2. And when simplified, the shares would value at rupees 150. Now when the dividend payout ratio is 50%, the value of the share shall be rupees 50. And when the dividend payout ratio is 100%, the value of the shares will further fall into 37.50. Now this is exactly what has been given here in the condition of R versus KE. Now whenever R is greater than KE, optimum dividend payout shall be 0. So if at all you try increasing the dividend payout, try increasing the dividend payout, then the value of the shares starts decreasing. For that matter, to simplify that, you can simply use the same information and check what happens when dividend payout is 0%. And when you do so, the value of the shares shall definitely be more than rupees 150. Now speaking of this, there is one more problem that has been given in the question. Uh, the question is determine the value of the firm using Gordon model. The equity capitalization rate is 10%. The internal rate of return, or R, for A company stands at 12%. A company stands at 12%, B stands at 10%, and C stands at 8%. Now payout ratio is, they have given for situation A it is 60%, for situation B it is 50%, and for situation C it is 40%. And earning per share they have given E to be rupees 10. Okay. Sorry, here this for situation A, the internal rate of return is 15%. So, taking into consideration the R and KE, what we can make is for situation A, it is a growth firm because R is more than that of KE. For situation B, it shall be a constant firm where B is equal to that I mean R is equal to that of KE. And situation C represents a declining firm where internal rate of return is lesser than that of cost of capital. Now considering all this, we are asked to find out the value of shares at each of the following situation. So IRR they have taken 15%, 10% and 8%. They have taken equity capitalization rate to be 10%, 10% and 10%, and earning per share is rupees 10 each for all the condition. So, for the first condition where R is greater than that of KE, it represents a growth firm. For the second condition where R is equal to KE, it represents a normal firm. And for a condition where R is lesser than that of K, it represents a declining firm. And now taking into consideration the formula, and the dividend payout ratio which stands at 60%, 50% and 40% and applying each of it in the formula for a dividend payout ratio and for a growth firm, the price of the share shall be rupees 150. For a constant firm it is rupees 100. For a declining firm it is rupees 88.24. And when the dividend payout ratio is 50%, for a growth firm, the price of the share is rupees 200. For a constant firm, the price of share is rupees 100. And for a declining firm, the price of the share is 83.33 rupees. And when the dividend payout ratio is 40%, for a growth firm, the price of the share is rupees 400. For a constant firm, it is rupees 100. And for a declining firm, it is 76.92 rupees. So here we can understand the relationship between the rate of return or the internal rate of return and that of capitalization rate. For a growth firm or a firm where return is more than that of cost of capital, the higher the dividend payout ratio, the lesser shall be the value of the shares become. Now, for a constant firm, no matter what is the decision regarding the dividend that has to be paid or the amount that has to be retained, the price of the shares of the company shall remain constant at all the stages. And for a declining firm or a firm which has internal rate lesser than that of cost of capital, the lesser the dividend is paid to the shareholders, the lesser shall be the value of the shares valued in the market. Now that has been what is given in this particular thing. That is, when R is greater than K, the price per share increases as dividend payout ratio decreases. The growth firm should distribute smaller dividends and should retain maximum earnings. The explanation is nothing but for a growth firm, there shall always be opportunity for investing more and more. When this is the case, the company has to retain all the money and invest it in the opportunities. Distributing in the form of dividend and again raising will be costlier than that of retain. And when the R is constant to that of K, price per share remains unchanged and is not affected by dividend policy. And thus for a normal firm, there is no optimum payout ratio. And when the rate of return is lesser than KE, the price per share increases as the dividend payout ratio increases. And therefore, the shareholders of declining firm will always stand to gain if the firm distributes its earnings. For such firms, the optimum payout ratio will always would be at 100%. So take a moment and look into your own soft copies or the hard copies of the study materials that has been distributed to all of you. Now speaking about the Gordon model of dividend decision, there is something called as the bird in hand theory. Now the bird in hand theory, to summarize, tells that whenever it is dividend and the shareholders, they consider that the money earned today or the money that shall be there in the hands today is far more better than the money or the future dividend or the future earnings. Now, this particular thing regarding the bird in the hand theory was started to be considered after Gordon has revised his model, and in his revised model he considered risk and uncertainty. So Myron Gordon, he revised his dividend model and considered the risk and uncertainty in his model. Now, this particular theory is based on two arguments. The first argument is investors are risk averse. And the second one is investors will always put a premium on certain return and discount on uncertain return. Now, speaking about the first one, investors are risk averse. It tells that no matter who the investor are, they try not to face the risk or they shall always avoid the risk. And the second one is whenever the shareholders know that there is certain return and regarding certain return they'll have to take a risk, they shall always put a premium on such returns. And whenever they know that the returns are uncertain in nature, then they shall always put a discount on such uncertain return. Now, this is simply to tell that this particular model takes into consideration that the value, the amount or the money, what is available at present or right now or for this moment or for this day is preferable to what may be available in future. Now this is what every other investor does. So this our investor does because these investors are rational in thinking. They always want to avoid risk, and on the other hand they also want to avoid uncertainty. And because of this they will always prefer to pay a higher price for shares on which the dividends can be earned today and and which are better off in the market, and they would always discount or try giving lesser value to shares of firms which tries to postpone its dividend to the future rate. Now speaking about this discount rate, it always varies with the retention ratio. Now the relationship between the dividend and share price according to the Gordon model is taken as follows, where the formula goes as P naught is equal to G naught multiplied by 1 plus G, the entire numerator divided by Ke minus G, where P naught represent market price per share or what is called as ex dividend, D naught represents current year dividend, G represents a constant annual growth rate of dividends, and Ke represents cost of capital. Now this particular formula shows that when the rate of return is greater than the Ke or cost of capital, the price per share shall always increases because the dividend ratio there would have been decreased. And the case is always vice versa. That is, if the return is less than that of cost of capital, then the price shall decrease as dividend ratio increases. And the price per share shall remain unchanged where the rate of return and the discount rate are constant. Then speaking further, there is one more thing what is called as dividend discount model or DDM. Now speaking about dividend discount model, now when we use such model, the use is that it will always evaluate the shares at the discounted value of the future dividend payments. Now that is to tell it considers the future dividends that would be paid, and for such a share what shall be the current price shall be decided. Now under this model the price of the share will be traded shall always be calculated by the present value of all the expected future dividend payment and that shall be discounted by an appropriate risk adjusted rate. Now here the intrinsic value represents sum of present value of future cash flows, and the intrinsic value represents sum of present value of dividends plus present value of stock sale price. And therefore, the stock's intrinsic value shall be D1 divided by 1 plus KE to the power 1 plus D2 divided by 1 plus KE to the power 2 and until Dn, which is divided by 1 plus Ke plus Rvn divided by 1 plus Ke to the n. So, in the above equation, it is assumed that the dividend is paid at the end of the each year and the stock is sold at the end of the nth year. Now, RV is nothing but the sale value or the value for which the shares has been sold. Now, speaking about dividend discount model, there can be three possible situations. Now, it could be zero growth, it could be constant growth, and it could be a variable growth. Now, the first one is the zero growth rate. Now, under zero growth rate, it considers that every dividend that has been paid by a stock or a share will always remain same. That is to tell, what you earn over a share as dividend this year shall be the same amount what you will be earning in the next year. And therefore, under such a circumstance where a dividend shall never grow, the intrinsic value of the stock shall be annual dividend divided by required rate of dividend. That is, P naught is equal to D divided by K, where D represents annual dividend, K represents cost of capital, and P naught represents the price of the share. Now, there is a simple illustration to consider that is regarding X Limited Company. Now, X Limited Company is a no growth company and it pays a dividend of rupees 5 per share. Now, if the cost of capital is 10%, compute the current market price of the share. P naught is equal to D divided by KE. D they have given rupees 5 per share and KE they have given as cost of capital which is standing at 10%. So, the current market price of the share shall be rupees 50. Now, that is for a zero growth rate. Then you have a constant growth where the relationship between the dividend and share price on the basis of Gordon's formula. Now, the market price of the share P is D naught 1 plus G divided by KE minus G. Now, here when you compare the zero growth and constant growth, what is that? Here one thing that is constant is growth. There is a constant growth. There is a continuous constant growth. So, therefore, the formula is market price of the share is D naught 1 plus G divided by KE minus G, where P represents market price of the share, D naught represents current year dividends that has been declared by the company, G represents the growth rate of the dividends, and KE represents cost of capital, or in other words the expected rate of return or also the internal rate of return. And one thing that we'll have to remember is here, like the earlier explanation, G is always equal to B into R, or G is equal to ratio, payout ratio into G is equal to retention ratio into internal rate of return, or G is equal to B into R. Now we can go through the illustration. Now the illustration speaks of XYZ company. XYZ is the company having share capital of rupees 10 lakh, of rupees 10 each. Now it is distributes current dividend of rupees 20% per annum. Now the annual growth rate is annual growth rate in dividend is expected is 2%. The expected rate of return on equity capital is 15%. And you have been asked to calculate the price of the share by applying Gordon's model. When we take into consideration the formula, D naught has not been directly given. So what they have given is the share price, they have given 10, and they have given that the company distributes dividend of 20% per annum. So when you take into consideration the face value and the ratio of dividend payment, we can find out the value of the dividend that is paid annually. So rupees 10 into 20% shall be rupees 2 per share. Now the growth in the dividend that is been expected has been given. It is standing at 2% or 0.02. Now the KE or cost of capital is given at 15% or 0.15. Therefore, when you apply all the elements into the formula, it shall be 2 into 1 plus 0.02 divided by 0.15 minus 0.02. And when we simplify, the value of the share shall be 15.69. Now we have gone through the zero growth model, constant growth model, and the last one that is there is variable growth model. Now speaking about variable growth model, it is nothing but it happens in different rates. Now there is no any constantness or constant thing as to how much percentage of growth might happen every time. Or this variable growth is also called as multi-stage growth. Now usually this growth rate can be considered in three different phases. Now during the earlier years, it so happens that there shall always be a slower growth rate for the company's shares or the dividend that would be paid. After certain years, there shall be a steady rate growth. Now, usually the most common or the three different as we discussed is when you consider growth, initially what happens is that when the company is new, it has been well settled, it has opportunity. In the beginning, some of the years, it should be growing at a very high rate initially when the company is in growth stage. And once after it passes through that, the growth shall be a little bit slower as compared to the initial years, and there shall be a constant growth. When the company is very settled, well settled, it has everything, it has invested in all those things that is necessary, definitely it goes for a sustainable steady rate of growth wherein the company definitely earns the value, the shares definitely will be having a very good dividend, but year by year there shall be no any increase in the dividend. So variable growth models can take many forms, even assuming the growth rate is different for every year. But the most common form is one that assumes three different rates of growth: an initial high rate of growth, a transitional to slower growth, and lastly to a sustainable steady rate growth. Now basically the constant growth rate model is extended with each phase of growth, calculated using the constant growth method, but using three different growth rates of the three phases. Now the present value of each stage are added together to derive the intrinsic value of the stock. And there are chances that sometimes the capitalization rate or the rate of return or internal rate of return may be varied if changes in the rate are being projected. Now speaking about this, there is one of the illustration that has been given. Now a firm has been paid dividend at rupees 2 per share for the last year. The estimated growth of the dividend from the company is estimated to be 5% per annum. You are asked to determine the estimated market price of the equity share if the estimated growth rate of dividend raised to 8%, if it falls to 3%, and also find out the present market price of the share given that the required rate of return of the equity investors is 15%. So according to this, there are three situations. First one for the present market share, and when the rate of dividend has been increased to 8%, and the next one is where it has fallen to 3%. And you are asked to find out the market price for all the three. So first let us take into consideration the current market price according to the formula. Here P is equal to D naught 1 plus G divided by KE minus G. We are to find out the P, the D naught has been given, that is dividend of rupees 2 has been paid last year. One is constant, they have given growth rate, the company is estimated at 5% per annum. So 5 divided by 100 is 0.05. The cost of capital also they have given, as in the question where they have mentioned the required rate of return of equity investors is 15%. So 15 by 100 is 0.15. When we simplify it according to the formula, the current market price of the share is rupees 21. And we are also asked to find out the impact of the changes in growth rate at 8% on market price, or we are asked to find out the market price of the share when the growth is at 8%. Now here again all the information remains same except for G, which is at 8. So the value of the share is rupees 30.86, and The impact of changes in the growth rate when the rate growth rate falls to 3%, the market price of the share shall be 17.17 rupees. So, from this we can make out that the share will always vary according to change in expected growth rate in the dividends. That is to tell, whenever the shareholders expects that there shall be increase in the dividend or growth in the dividend rate, then the market value of such shares shall always increase. Whenever the shareholders anticipate that there shall be decrease in the amount of dividend that is going to be paid by the company, and for such shares the price value or the market value of the shares starts on decreasing. Now there are some of the advantages of Gordon model. Now the advantages of Gordon model is that the first one is, now Gordon model is called as a useful heuristic model, or specifically speaking regarding the dividend discount model, as it relates the present stock price to the present value of the future cash inflow. And the second advantage is that this model is easy to understand. On the same hand, they have given the limitation of Gordon model. Now, the limitation is that the dividend discount model will always depend on the projection about the company's growth rate and future capitalization rate of the remaining cash flow. Now, which may be difficult to calculate accurately. And the second limitation is that the true intrinsic value of stock is difficult to determine in reality. Now this is all about Gordon model. Speaking of this, there are now speaking of this, there are some of the problems that has been given in your PDF. Now all those should be self-explanatory. Please do go through that. It is easy to understand. Now there is one more model which is called as the irrelevance theory of dividend policy or dividend decision. Now that I shall be making a video and uploading to you all. And once after this meeting ends, please rejoin so that I can explain regarding the two other models which has been not given deliberately in your syllabus, but then understanding that would be better always. So, and that is where we shall come to an end of dividend decision. And speaking of this, there is one more chapter which is called as valuation of shares. Now speaking regarding valuation of shares, in one of the guest lecture, one of the lecturer had done the half of the chapter. That is, she had spoken regarding valuation of assets, valuation of bonds and valuation of preference share. She had covered almost 75% of chapter. What remains is valuation of shares, which I will be doing. But then because of the because of the not so I mean carelessness of yours, most of you all have not attended that particular session. I will not know what you shall all be doing for it, but valuation of equities I would be telling you all, but valuation of assets, valuation of preference and valuation of bonds, you will have to work on your own. So once this meeting ends, please join back.